Has the Federal Reserve spooked the market? Stocks are suffering a bout of volatility of a kind we haven't seen for the last few months, as the Dow Jones Industrial Average touched below its 50-day moving average for the first time since May, ending a period of low volatility that's really dominated this trading activity over the last few months. Investors were responding to a number of economic reports and also the release of the latest Federal Reserve meeting statement, both of which suggest that there could be a slight hawkish bent to Federal Reserve policy moving forward. We had a nice bounce back in second quarter GDP growth, covering up a weather and inventory drag down that pulled first quarter GDP growth to one of the largest non-recessionary declines in the U.S. economic history. We also had a fairly strong ADP private sector jobs report that bodes well for Friday's non-farm payroll report from the government. But the main thing was the Federal Reserve statement, which indicated that the Fed is acknowledging a bounce back in GDP growth, also consistent job gains, and a bounce back in inflation back to its 2% target. The big thing was a dissent from Philly Fed President Plosser, suggesting that the hawks, or the policy hawks on the Federal Reserve, are starting to acknowledge some of this bounce back and are looking to tighten policy perhaps sooner than the dovish members of the Fed were expecting. So that puts QE3 bond purchase program on track to end in October, and it also suggests that we could see a slight bump up in the timing of the first short-term interest rate hike, perhaps into the early part of 2015. Right now the market expects it sometime around June. Now Friday's jobs report is going to be key in this discussion. If it's strong, it's going to continue that pressure, and we could perhaps see stocks respond negatively to that with continuing volatility in the days to come.